Okay, welcome back. We're going to do retirement of bonds real quick. Well, maybe not so quick, but we have I'm using the one from up above, and this is the same example we had up here, which is the 10%, 12% effective rate 5-year bonds. I just brought the information down for the retirement here so that we can see what's we're going. And nothing else has changed. Everything's the same. So this is calculated exactly the same way we did before. And we got this table the same way we did before. The only difference is this time I stopped at June 30th of 2014 because we bought some of the bonds back on March 1st of 2014. And because of that, I need the next pay period's bonds because remember, these bonds here on December 31st of 13 would have been recorded already. When we sell on March 4th, we have to amortize the portion that we still need to calculate for that would be due. Okay, well, now hopefully it'll be a little clearer when we get through this. So we retired $30,000 of bonds at 97.5 on March 1st. So the first thing we need to do is find the carrying value. Well, the carrying value to start with is our balance that we have on the balance sheet. On December 31st, we'd have $95,082. Then we need to amortize part of the discount that we have coming yet. So we would take equal, this is the 705 times 2 divided by 6. Now, the reason why it's 2 divided by 6 is because this 705 represents 6 months worth of amortization. Remember, it's from December 31st, or January 1st through June 30th. So that's 6 months. And March 1st would only represent 2 of those 6 months, and that's why it's 2/6. So that will give us our discount up to this point. So our carrying value is $95,317 for the bond as of March 1st of 2014. Okay, so now what we have is we do the reacquisition price. Well, we know we have $30,000 worth of bonds, and we bought them back at 97.5. Now that's a percentage, so it's 0.975. Or $29,250. The carrying value is equal to the $95,317 times 0.3. So I'll put those over here. So we have the 30,000 times 0.975. And on this one, we'd have the 95,317 times 0.3. Okay, that gives us these values, and then the difference here is we take the 29,250 minus the 28, and so we have a loss of 654.90. Now, the way you can tell it's a loss is because we said, okay, here's what we said it was worth, 28,595. We paid 29,250. So anytime you pay more than what the book value is, you had a loss, because you paid for more than book value. So, okay. Then we're ready for the journal entries that we have down here. The first thing we have to do is, because we're buying these between interest payments, the $30,000, those people would like to have their interest. I know they only have 2 months worth of interest, but they still want the interest. They don't want to give it up. So the interest expense, we come up here to our table, is the 5705 times 0.3, because we want to get rid of 2/3 of it, and 2 divided by 6. So this is the 5705 times 0.3 times 2 divided by 6. That's how you do that one. So the interest expense recorded on these $30,000 worth of bonds would be $570.50. Then we have the discount on bonds payable, and again, that is the 705, because that represents the next month's payment, next pay period, but it was only 30% of it, and it's only for 2 of the 6 months. So that gives you $70.50. So I'll do it over here. You have a 705 times 0.3 times 2 divided by 6. Because remember, this is next month's pay period. And for the cash you're paying out, it's the 5,000 times 0.3 times 2 divided by 6, which is the 500. So it's 5,000 times 0.3 times 2 divided by 6. Okay. That takes care of the cash that you have. That takes care of the interest that you owe. Now we're going to actually pay for the bonds. Okay. Well, we know the bonds payable is always at face value. That's $30,000. The loss on early retirement we already have calculated right here, so there's no reason to do it again. Actually, don't want to do it again. The cash is easy because we already have that calculated. That's the $29,250. That's 30,000 times the 97.5. And now this one's a little trickier. Well, you could be real easy. You could just make whatever makes a balance. But the way you should do it is you take, okay, the full value of the bonds was for the 100,000 up here, minus the carrying value of 93.17, but we only want 30% of that, and that gives you 1404.90. Okay, so I'll put that in here so you can see that one. It's the 100,000 minus the carrying value of 95,317 times 0.3. Okay, and the rest of these we have calculated. So this is, now some people would ask, why would you do that if you're going to have a loss and you know it's a loss? Well, keep in mind, it's $30,000 worth of bonds, and they was going till 2016. You no longer have to pay interest on those bonds. So the interest that we have is the $30,000, roughly $3,000 a year we're saving in interest, or $1,500 every pay period, because we're reducing the amount of bonds that we have, so we're saving the interest charges. So what's more than makes up for the $654 loss that we have. And that's how you really determine if you want to buy a bond back or not, or redeem them or retire them early, is saying how much interest are you saving, and is it going to save the company money in the long run? And in this case it is, and that's why they would buy these back earlier. Well, I hope this helps, and this is how you do the retirement of bonds. Remember, you always have to use the period after your last amortization that you've done. Whether it's a premium or discount, it doesn't matter. You use the next pay period to see what the value of the bonds would be. That should take care of this. So we'll see what happens next time. Until the next video, bye.